smaller, more boutique shops outperform the bigger shops with the generic mandate. If you're looking at long-term trends like 10-year, 20-year data, and you do see the truth in these numbers that are biased towards the boutique, which have outperformed the bigger shops.
Flexible multi-sector funds have outperformed core and core plus funds by about 1% over every rolling 10-year period over the last decade. A flexible generalist approach, looking for the best ideas in the entire market, does better than having a very siloed approach with analysts and portfolio managers and traders. But it's a matter of incentives. In a boutique firm, you'll find that the managers are incented based on performance, which goes directly to the client, which impacts their success. In the larger firms, the incentives are asset gathering. And not to say performance isn't important, but it takes a second seat to asset gathering.
Now, I've come up in the industry with that three-leg stool process of investment, which is the trader, the research analyst, and the portfolio manager in the circular communication that happens.
When you go to a sector-specific credit analyst and you say, give me your best idea, it's going to be within that sector. And they don't know whether that's the best idea in the market or not.
If I'm in my silo or, I have blinkers on for that job requirement that my job title holds, I am preoccupied with my one niche. And most of the time, I don't even understand the impact it is having on the overall portfolio, let alone driving the agenda of the portfolio, driving total return for the portfolio.
The theory behind having analysts and portfolio managers and separating the two decisions is that there was supposed to be a creative tension between the two. Okay? Portfolio managers are focused on generating total return and beating their competitors. Analysts, regardless of their sector, are predisposed to avoiding risk. Portfolio managers, on the other hand, want to take risk so they can outperform. Now, the question is, how do you reconcile those two mindsets?
There is definitely seepage and leakage in the way that is implemented. And when I go to sleep as a research analyst or as a trader, I pat myself on the back thinking job well done, as in I've delivered my best idea, I've extracted the best value for that idea as a trader. But I'm not thinking of the overall portfolio. I'm just thinking about my job title, my requirement, rather than what we in this industry should do, which is think about the end client and delivering the best impact for that end client, which is what lends itself to the generalist line of thinking.
In a generalist shop like we have, where Shweta and I came up as analysts, but are now portfolio managers, we can balance that conflict to make a better total return decision for our clients. As a generalist, we view the entire market, we view the entire risk landscape and decide for a given amount of risk, is this sector the best tactical move or is another sector the best tactical move? When Silicon Valley Bank had its problems, we were looking at the entire market and we said, you know what? Those problems of Silicon Valley Bank are idiosyncratic to that bank and that management team. But the entire banking sector was cheapening up at the time. The problems at Silicon Valley Bank aren't going to be the problems at JP Morgan, aren't going to be the problems at Bank of America. And we decided to overweight those types of banking credits in our clients' portfolios and did quite nicely, because then after the market realized that, the spreads on those credits tightened up and we made some money for our clients. The thing about a boutique, I only had to talk to my partner to get that decision made. We both have heavy credit analyst backgrounds. If I was in a larger firm, I was going to have to submit that idea to the banking analyst. I was going to have to wait for the banking analyst to come back. That was going to take time. Depending on the analyst and how they feel about taking those kinds of risks, odds are, in my experience, they would have shied away from it. It would have taken a longer time for them to get comfortable with that result, and you would have lost the opportunity.
And as you scale and become really big, by that very nature, you start looking at aggregates, not individuals. Maybe then your wrapper changes to an ETF or it changes to a mutual funds. Pooled vehicles. Pooled vehicles, by their very nature, have to outperform a benchmark because you're no longer looking at Mr. and Mrs. Smith. You are looking at a big pool of dollar amount that has to be invested, and it has to be invested using a certain process. We try to find a holistic synergy in not compromising the process, but truly focusing in or honing in to at Mr. and Mrs. Smith. What is their time horizon? What are they looking to do? Can we customize it? Can we get the best results for them rather than a pools of asset with amorphous end client, right? You're just looking at that pool and you have to stay true to the mandate. At City Different Investments, we always like to say we are benchmark aware, but benchmark agnostic. Our value is the value we provide to the end client, and the client doesn't go to sleep every night thinking of what the benchmark has done. But if I am running billions and billions in asset, as a PM, I'm going to sleep thinking of what the benchmark has done, how is my performance in relation to the benchmark. At City Different Investment, we're thinking about Mr. and Mrs. Smith. Am I delivering total return to them in the best format possible? And that's not alone measured by performance. And if I'm beating the benchmark, that is driven by, am I accessible to them? Am I truly doing what I told them I would do? Are they aware of why am I taking these decisions? And am I being completely transparent and accessible to them? So at City Different, I'm thinking I'm being judged on all these different verticals, and I need to come true to what I have promised them. And am I partnering with them in the best way? And unfortunately, in the bigger shops, the only true standards that I know is, hey, am I beating the benchmark? So it's misalignment of incentive.
Also, it allows us to be what I call market makers versus market takers. When you manage a large pool of money, you're at the disposal of your investors. Sometimes they give you a lot of money, typically at the wrong time, and sometimes they want their money back, typically at the wrong time. And when you're that large, you have a tendency, or you could swamp the intermediaries who are making the markets for you. Typically, when markets are rising, shareholders are going to want to buy a lot of the fund, and you're not going to be able to get invested fast enough to take advantage of that rising market. Absolutely slower, because you have multiple layers to go through to make a decision. I'll use a specific example. So the fires in California were horrific. I was out there visiting my daughter when they happened. She lives in LA. One of the big issuers in LA is the Los Angeles power company called LADWAP, Los Angeles Department of Water and Power. All of a sudden, LADWAP was a AA rated credit, usually trades through or richer than AAA general market scale. All of a sudden, because of the fires and because of people's views of the credit, it was trading 70 to 80 basis points over AAA rated credits, the AAA rated scale. I called Shweta and I said, am I nuts, or does this look like a value? And she goes, yeah, it's not going out of business. I agreed. So we were able to buy it for clients and put it in their account. Okay. If I had worked at a larger firm with segmented credit analysts, I'd go to the credit analyst and say, what do you think? They'd take a couple of days to review the credit. They'd come back, probably not wanting to do it because of the risk involved, and you miss that opportunity. We were able to take that opportunity. Now those spreads narrowed right now to about 40 over. So it made sense for our clients, and it helped their accounts.
So that was actually a really wonderful opportunity that we could take advantage of, that maybe in the bigger pooled vehicle wrapper, you would not be able to take advantage of. And in our separately managed accounts, we were able to take advantage of. And that is just one of many instances where we can think out of the box and really look out for the end client in our investment process.
We are just faster to make a decision. The market is dynamic. It changes all the time. So these opportunities are not long lasting. So being faster allows us a better opportunity for our clients.
What drives us to come to work every day, sure, is asset under management. I would be hypocritical if I said otherwise. However, it is driving the best overall results for the client that comes not just in the version of performance, it comes in the version of transparency, accessibility, explaining to them what is it that we do, the rationale behind our decisions. So the communication part, the partnering part is as important, and that drives AUM as much as performance drives AUM. But chasing AUM is short-term in our minds. We believe in long-term partnerships with our clients, and that shows itself not just in performance, it shows itself in the form of communication, in the form of true partnership, which can look at which looks like customization of the portfolio, which looks like being present or being accessible to them in times of market volatility, which can also manifest itself in our weekly communication of, hey, this is what is happening in the market. This is what we are thinking. We might not be right all of the time, but you would understand or have access to why is it that we are doing what we are doing.
I will say one of the reasons that boutique firms, especially the way we're focused at City Different Investments, are different from the large firms is that our clients have access to both Shweta and I if they need to have questions answered. And you don't always get that access at the larger firms.
You have a full insight into our investment process and the reason behind our decision making. Partnering with clients is something that is personally really important to me. Where the transparency and accessibility piece starts for us is the very beginning. When we meet or talk to the RIA, registered investment advisor, to the end client, we explain what our process looks like. How do we choose an idea? What is our philosophy of investment? And everything that entails from the beginning to the end. That, though, is just the beginning of building that relationship. It is then followed up in everyday small steps of, this is what is happening in the market. This is why we are doing X, Y, and Z decision based on whether we are looking at credit, at allocation, at our performance. Why did we outperform or underperform both of these scenarios in the form of performance attribution that we share with our end clients, not just in investor letters, but on a weekly basis. We are accessible to our clients on phone calls, Zoom calls.
What we do here with the weekly commentary. We tell our clients what we're seeing, how that's affecting our strategies and tactics. And as I tell our clients, you can call Shweta and I anytime. We'll give you an answer on what's going on in the market. We'll answer your questions. And it doesn't matter who you get to, because you'll get the same answer.
We believe that we are answerable to our end clients. And if we don't have a good answer for them, we should not be managing their money. At City Different Investments, we implement our total return philosophy using an actively managed ladder, by which I mean we There are rungs of the ladder that we are overweight and underweight, and that is to mirror or to implement parts of the curve that we find attractive.
We think that's the best total return vehicle for our clients. When I first started in the business, I would be getting pitches from Wall Street to change my security structure in the portfolios I was managing, to go from a laddered structure to a barbell to a bullet. Wasn't great for our clients, but it was great for the salesperson because they were able to get a better commission on those transactions. So I started doing a lot of work back then to say, my thought being, there must be one good structure to stay in. And the results came back that it was a laddered structure, and an actively laddered structure. So what I found doing that research is that a laddered portfolio outperforms a barbell portfolio or a bulleted portfolio 60 to 70% of the time. And it also creates lower tax liabilities because you don't have a high turnover of transactions.
Also, the ladder is a beautiful hedge to any kind of asymmetrical changes in the yield curve. And we have years of history to prove that.
We think that's the best total return vehicle for our clients. In our 1 to 10 year strategies, we are overweighted 1 to 5 years because the yield curve is very flat. The difference in yield between a 2-year and a 5-year is very small. So we're overweighting the front end of the curve. The other thing is, just from a value perspective, I can buy a 5-year bond in either the municipal market or the taxable market, and it yields about 90% of the income of a 10-year bond for 50% of the duration risk. That long-term average, again, looking at our benchmarks, runs around 70%. So in our mind, that's a great value. That's why we actively manage the ladder the way we do.
At City Different Investments, we do believe there is an advantage to being a boutique.
We are focused on the client and what is in the best interest of the client, rather than gathering assets. We had this client call up and says, I want to park $30 million in your limited term fund for 6 months. I said, great, take it someplace else, because it's only going to be here for 6 months. We can't invest it based on the objectives of the fund. All they're going to do is dilute the dividend of our existing clients and take the benefit for themselves and then leave. So as I said, we had a series of phone calls, 3 or 4. The client eventually called back, the advisor called back and said, I'm giving you $15 million long-term money because I've never had a portfolio manager turn me down before, and I like what you said. So at a boutique firm, I know the way we manage it, we want to have a long-term relationship with our advisors, and we'll do things that are in their best interests, even if at the margin they don't seem like they're in our best interests.
Because what is exciting here is that you understand who the end client is, what is their mandate. It's not running a pooled vehicle for people that enter and exit and you're running your mandate. This is a very personalized experience for both the client and the portfolio manager alike. It's not a nameless entity. I understand who I'm running this portfolio for. I'm understanding of the specific customization that the portfolio needs, the exact after tax or the exact tax bracket that the client is in. And it can lend itself into looking for very specific custom ideas for the end clients